Trouble is brewing in the restaurant industry, and several brands are now silently closing locations and reducing their operations to cope with a consumer recession that has no end in sight. Managing a restaurant is never easy, and during an economic downturn, conditions get even more complicated because people tend to cut costs and eat out less. Declining sales and guest visits at physical locations are actually some of the main reasons why chains decide to leave a market or even file for bankruptcy. Not even the biggest companies out there are safe from the trends that are plaguing the industry in 2023. Many of them are being crushed by inflation, labor issues, and rising competition. In this game, only those who know how to adapt will be able to weather the storm. In this video, we've compiled chains that seem to be losing ground and falling behind their main rivals. According to analysts, they are at risk of mass closings and can go out of business entirely sooner than people think. So, without further ado, here are 15 big restaurants that will disappear in the coming months. 1. The Cheesecake Factory. Although the Cheesecake Factory was, and still is, one of the most popular fast casual dining franchises in the US, the brand has been facing some serious financial setbacks in recent years. Founded in 1972, the chain rapidly expanded to over 400 locations in North America, but that number declined to 297 in 2019, and the pandemic triggered the closure of another 10% of its locations. In 2021, 2022, and 2023, more restaurants went dark as foot traffic at shopping malls slowed down. Today, the Cheesecake Factory has just 213 restaurants, and about 13 of those were recently rebranded as Grand Lux Cafe. The company is scrambling to adapt to new market trends and draw in a younger customer base. After more than 5 decades in business, the Cheesecake Factory has seen competitors rise and fall. But now, the tables have turned, and its rivals are watching its gradual decay. 2. Ponderosa Steakhouse. Previously owned by Homestyle Dining, the downfall of the steakhouse chain, Ponderosa Steakhouse, started to accelerate in late 2017 when dozens of underperforming locations were permanently shuttered. Only 1 year before the closings, the company hit a peak of 300 locations across the nation. But then, traffic started to decline, and so did sales. By 2018, there were only 197 restaurants still being operated in the United States. The chain, founded in 1971 and became famous for its vast menu offerings, from steaks to seafood, chicken entrees, as well as a multitude of options at their buffet. In 2020, the pandemic further complicated things in Ponderosa by making buffet-style restaurants decline in popularity. For that reason, Homestyle Dining decided to sell it to Johnny Rockets for $25 million. Since then, more closures ensued, and now there are just 22 Ponderosa Steakhouses across the country. 3. Red Robin. For at least 5 years, Red Robin has been on Macro Access's bankruptcy watch list. The casual dining restaurant chain has faced lawsuits due to poor health and safety conditions, abusive labor practices, and bad customer service. Its customers have also been complaining about the declining quality of its products, with sales disappointing quarter after quarter. Last week, the chain also registered a bigger fall than the market, missing earnings expectations once again. Due to its worsening financial hardship, industry analysts say Red Robin is on the verge of closing for good. 4. IHOP. Since the 1950s, IHOP has been catering a variety of items for its American customers, constantly changing its menu to adapt to changing tastes. Unfortunately, no matter what IHOP does, the chain just can't keep up with customers' demands. But that's a problem the entire full-service restaurant sector has been dealing with over the past decade, and IHOP just happens to be one of the biggest out there, facing the highest amounts of exposure. Things have taken a dramatic turn for the worst in 2020 when lost sales led to severe profitability and cash flow issues that led the company to rapidly reduce its store count. Over the past 3 years, about 12% of IHOP restaurants have closed their doors for good, and as it cuts on costs to improve its bottom line, more closings are expected in the coming months. 5. Noodles and Company. For the past 6.5 years, Noodles and Company has been struggling to turn a profit. The chain's business model seems way too antiquated for an ever-evolving restaurant market. Between 2017 and 2021, sales losses have more than doubled. In recent years, more than 60 spots have been closed as revenue continued to shrink. The company is trying to attract new customers by adding new items to the Noodles and Company menu, such as vegetable noodles. However, so far it seems that the move didn't make any actual difference. This week, the restaurant's stock recorded a 13.31% drop after it released its earnings reports. Profit margins took a hit again as earnings fell at a faster pace than revenues. Noodles and Company has performed so poorly during the past few months that Investors Observer said it was a bad investment right now and put it in the bottom 25% of stocks. The future of the restaurant chain remains uncertain, and it will likely have to close more of its locations to be able to manage its finances. 6. Dennys. When this chain was founded in 1953, it used to be a coffee shop named Dennys Donuts. But as it started to gain popularity, it was transformed into a restaurant chain that operated in several states and countries. While there are currently more than 1,500 locations of Dennys nationwide, that is down from nearly 1,700 in 2016. The company has suffered massive financial losses after facing multiple discrimination lawsuits over the years. Conditions also haven't been great recently. Shareholders have seen the stock collapsing by 41% since 2018 and 27% just in the last 60 days. Analysts believe that the company's revenue drop of 8.9% a year for half a decade suggests that Dennys can't grow in the long term, which is leading investors to abandon its stock and sparking worries about the sustainability of the chain. 7. Hanan. The iconic Japanese-themed restaurant that offered amazing dishes served tableside was a huge hit in the 1990s and early 2000s, but unfortunately, it hasn't been able to remain successful in the past decade. Founded by Hiroaki Aoki, the chain once operated more than 250 locations, but less than half have survived. As of September, there were 93 Benihana restaurants in operation across America. The decline was thanks to rising competition and new consumer trends brought on by the pandemic. 8. Sonic. Sonic markets itself as America's favorite drive-in, but U.S. customers may think differently, given that traffic has been steadily dropping since 2019. The chain hasn't been performing well in the past few years, plagued by inflation, supply chain issues, and shortages of labor. According to CEO Cliff Hudson, continued aggressive discounting by the competition and unfavorable weather are also contributing to Sonic's problems in 2023. Even though the brand has been currently working on improving the quality of its food and attracting the young generation, sales continue to go down, causing franchisees to go bankrupt. 9. Hard Rock Cafe. One of the oldest fast casual dining chains in the world is having trouble staying in business in the United States. Despite marking generations of young Americans, Hard Rock Cafe is finding it difficult to connect with the current public. Consequently, financial results have been deteriorating in its restaurant segment for 4 consecutive years. The brand also owns a number of other businesses, including hotels and casinos. Citing profitability problems, Hard Rock International has decided to shutter multiple cafes in the country this year, including locations in Houston, Las Vegas, Denver, Seattle, and Memphis. 10. Carabas Italian Grill. Owned by Blooming Brands, the same parent company of Outback Steakhouse, Carabas Italian Grill is facing similar issues as its sister chain. With fewer and fewer customers showing up at the restaurant, Blooming Brands is having to protect its business by closing hundreds of underperforming locations, including dozens of Carabas restaurants. This year alone, 43 locations have been shuttered, and now the chain is operating fewer than 220 branches around the country. If it fails to restore its financial health over the next few quarters, the brand is likely to face even deeper cuts to its store count, which may put it at risk of bankruptcy. 11. Checkers and Rallies. Fast food chains Checkers and Rallies are known for their hamburgers, hot dogs, fries, and milkshakes. They cater to customers in 28 states across the U.S. and used to be praised for their fast service and fair prices, but with each passing year, the franchise has been closing more locations due to falling sales volumes and squeezed margins. To make things worse, the companies have faced mounting criticism after regulators revealed they've been violating health code requirements in several restaurants. 12. Marie Callender. Many people are familiar with the Marie Callender brand of frozen foods that are sold at grocery stores, but the business started as a restaurant in 1948, and there are still locations in operation as of 2023. However, Restaurant Business reports that yearly sales have been declining by an average of 3.6% since 2015. In 2019, that number jumped to 25.2%, and the health crisis drove the company to bankruptcy in early 2021. Back then, 31 locations were closed, and today, only 25 restaurants are still in business. If you are a Marie Callender fan, you should probably plan a trip to your nearest location because store closings continue increasing and sales showing no signs of recovery. In other words, there's no telling how much longer this beloved chain will be around. 13. Carl's Jr. Carl's Jr. seems to be gradually retreating from the U.S. market. The chain first opened its doors as a drive-in barbecue restaurant in 1945, recording an impressive growth not only in America but all over the world. Sadly, superfans have seen less of Carl's Jr.'s in the past couple of years as the company has closed hundreds of locations and decided to abandon its indoor dining services in favor of drive-through, pick-up, or takeaway services, which prompted some customers to start taking their dollars elsewhere. 14. Potbelly Sandwich Shop. Fast casual restaurant chain Potbelly Sandwich Shop offers sub sandwiches and milkshakes in a market that seems to be already crowded by failing sandwich shops, including Subway. The brand hasn't really found footing among changes in the fast food industry. In 2019, it partnered with DoorDash in an attempt to get more regular diners, but that didn't solve its long-term issues. Now, it's trying to do renovations to draw customers back in, but that's after having to close about 25 locations this year due to poor sales. 15. Burger King. Oh, yeah, not even big brands are safe these days. Burger King is the third biggest fast food chain in America, but it used to be the second before Wendy's snatched the crown. The company has fallen into hard times, and Burger King is still struggling to recover in 2023. New restaurants are disappearing at an unprecedented pace. Between 2020 and 2022, roughly 200 Burger King locations have been shuttered each year. This year, conditions have gone from bad to worse as 3 major operators have filed for bankruptcy, leading the brand to close down more than 400 restaurants. While rivals like McDonald's and Wendy's continue to expand, and other chains like Shake Shack and Five Guys are cutting menu prices to boost sales, Burger King is oddly overpriced right now, and that is leading customers to buy fewer items less often, which spells more trouble ahead for the burger chain. Now, if you have a beloved restaurant and you're in a position to support their business, you should visit your favorite spot now. Restaurant closings can happen overnight and without any notice, even for the staff. This is the rockiest market many of these brands have ever seen, and things are not likely to get better anytime soon. When and only when the U.S. consumer regains their economic resilience, non-essential businesses will see growth again. But for now, the outlook remains cloudy, and thousands of locations are going to disappear before you realize that they were gone. What news do you have where you live? We'll look forward to reading your comments, and thank you very much for watching.